Good evening, everyone. From where you are, good evening, morning, good afternoon. I know we have people who listen from different parts of the world. We do have Mango Spaces on Thursdays mostly. Sometimes we do Tuesdays and Fridays, but Thursdays are our main days. And today we are going to actually look at some of the investments that most people are always interested in our Kenyan market. And we are looking at unit trusts because of late we've seen a wave in the space with the money markets, but it's just probably one type of a unit trust. And we want to look at the whole spectrum of what a unit trust. Because we can see from last year, we had a jump of about 4.1% growth. That is from 206.6 billion to 215 billion recorded by CM, which are assets under just unit trust. So we want to understand what are these unit trusts that people are now more interested in? What is the wave that is making the uptake go up time? And that is last year's record. So you want to understand what is the web, how do they work, what are these units? And to have that understanding and discussion, we have our able speaker, one from Kuza Asset Management and another one from Uphope Asset Managers. I'll just let them introduce themselves and tell us what they do at each of their respective companies, and they'll be able to actually let us understand more about unit trust. We have Bill. I can see Bill. Bill from Kuza. Bill is our CFA. Bill Ono, the portfolio manager from Kuza Asset Management. And we also have Wilson Wariara, a CIO, that is Chief Investment Officer from Uphope Asset Management. So Wilson, you can tell us a brief introduction of yourself, what you do at Uphope generally.
Good evening. Thank you, Namsia. My name is Wilson Wariari, the Chief Investment Officer at Avocap Asset Managers. Avocap Asset Managers, we are the new kid in the block now because it has been 4 months since our unit trust scheme was licensed by the Capital Markets Authority to offer the unit trust services in the market. So a brief background about myself. I'm an investment banker. I've started off as an international derivatives trader, traded for an international company, so traded global markets. And after 4 years in international markets, I then came to the local markets as a private manager. Now with the Diamond Investment Bank, mostly looking at the high net worth individuals, guiding them in investments both locally and offshore. And while doing this, now that's when we realized the gap in product offering in the market, especially the unit trust space, between the investment products that the clients can access in our market here locally and the opportunities that are there to be created to solve some of the investment needs. So that's how Avocap Asset Managers was born, to come and bridge this gap to provide the investment solution needs. Every time we speak about financial planning and we speak to clients about now you should plan your financials well, you should adopt savings plan, but how then do we transition those from just a plan to actualization of these dreams? And that realization that at times these plans do not just fit one basket. So how do we create these investment products that actually fit and will help our client make the right investment decisions? So basically, that's what we are doing at Avocap Asset Managers, having these unit trust products that are there to assist clients to plan their wealth. So we're looking at fund management with a wealth management perspective. If you have these needs, then how do you create these products that, and I'm not sure as we go down to what the unit trust are and how to go about the unit trust market, I will dig deeper into how some of these solutions can be created within the unit trust space.
Thank you, Wilson. Bill, you can tell us about yourself, a brief introduction, and what you actually do at Kuza Asset Management.
Thanks very much, Namsi, and good evening, everybody. My name is Bill Olo. I'm the portfolio manager at Kuza Asset Management. And my day-to-day role is to basically develop capital market expectations for the entire firm, as well as oversee the investment execution of all the decisions which are made. I'm a 9-year finance professional, and I've had experience in basically equity research. I've also done a stint as a corporate finance analyst, and at the same time, I've also done a stint also in private and public asset management. I think I just want to take a short time to just briefly introduce Kuza Asset Management, and then I can hand it back over to you, Namsia. So Kuza was formed in October of 2021, and we got our CMA license in April of 2022. We basically opened our office in July of 2022. And 25 months later, we've made quite a bit of progress. We have around 2,161 clients. We manage 1.26 billion Kenyan shillings across basically 10 products. And effectively across the different products, we tend to be amongst the top performers. Just if you actually look at money market fund, Kenyan shilling, money market fund, US dollar, as well as the fixed income fund. And the name Kuza basically stands for the word nurture in Kiswahili. So we definitely are very big on financial literacy, and we definitely try to work with clients so that at least we could actually be able to move from one level to the next on their financial literacy journey.
Thank you so much, Bill, for that introduction. We can all agree that we have great minds for our topic today. We really need to understand from a professional perspective, because when you're giving money to someone, we need to understand how they're managing our money. Do they even know what they're doing? And on that note, you can actually send in your questions, your queries, and anything pertaining unit trust or money markets or anything. Just write it to us. We'll be able to catch it later. What is a unit trust? If you can tell us what is a unit trust and what are the characteristics of unit trust. You can start with you, Bill.
Sure. According to the Capital Markets Authority, a unit trust is simply a pool of assets which have actually been gathered together based on the contributions of members. And according to the regulations, we have a variety of unit trusts. So we have a money market fund, we have an equity fund, we have a fixed income fund, and at the same time, we have a balance fund. And if you were to look at the latest statistics, around 86% of the funds are domiciled in money market funds and fixed income funds. And according to the latest statistics we have, at the end of the first quarter of the year, we had around 225 billion shillings in unit trusts. However, as Kuza Asset Management, we try as much as possible to look at the potential size of basically the unit trust pool. We have around 2 trillion shillings, which basically lie with local banks, especially as current account deposits. So we actually think that we're scratching the surface when it comes to unit trust. It shows that we are basically 10% there. And so there's a lot of room for clients to grow. So in a nutshell, in Kenya, money market funds and basically fixed income funds tend to be the most prominent, in part because they offer very good returns. And again, depending on the customer profile, one could actually be able to position oneself accordingly. Of course, we still have individuals who basically expose themselves to equity funds and also balance funds. But as of right now, money market funds and fixed income funds tend to be the most popular ones. I think I'll just close off my answer with the following observation. Especially in Kenya, I think the one thing we definitely see a lot is that individuals definitely want to grow their disposable income, and basically generating inflation-beating returns is something which is extremely important for them. Hence the reason why you find money market funds and fixed income funds over equity funds tend to be the best way to go, in part because we've seen historically some of these funds generate, let me say, superior competitive returns, especially over time. And I think as Kuza, we definitely would strongly recommend that perhaps you can just be able to go to our website. You can also be able to look at our app so that at least we can engage with you from there.
I also want to hear that perspective from Wilson on when a layman person comes to you and wants to understand what is a unit trust. How would they explain a unit trust to a person who has no idea about investments, and you being the new kids on the block? Probably have a different perspective, because coming into the market that is already thriving and maybe the way you play in the market, but you still had to come in the market. It means you had seen a gap. Probably, I don't know. You could tell us what gap did you see, and how can you define unit trust?
Okay, thank you, Namsia. One, unit trust, the way we look at it, let me go to how they are defined here, collective investment schemes. So that's how basically CMA does define them. So when you look at collective investment schemes, so what does it mean? It means that now you are aggregating several investors to create this pool of investments. And from this pool of investments, now you can probably manage risk better. And the way we look at the unit trusts and the way we look at now basically now these collective investment schemes. At Avocap Asset Managers, the gap we saw was in active management of investment. That, as Bill has said, that we have this huge concentration of products in the money market. So, and you look at now, there are other, we are said now there's the equities fixed or the fixed income unit trust schemes or unit trust products, but they are mostly passively managed, or that's what the market currently does. And so we looked at the gap that is there in terms of active management of the unit trust schemes. In the equities, for example, speaking about the equities market, in the country now, we don't have an active. So most of the unit trust schemes, we have balanced funds. So basically, they have a portion of fixed income and a portion of equities. We don't have pure equity funds, or actively managed equities fund. So these are the gaps that we saw in the market. That there was a lack of active management. That what was mostly there was passive.
Maybe we continue with you, Bill. Bill, you just mentioned that money markets are the most common ones. Wilson was trying to actually lay further why money markets are also common, and you also try to explain that. But then how do these products differ in terms of risk and return? That is money market, the balance funds, and the equity funds, all these products are that they probably, if we understand the risk and return of these different assets and the unit trust, we might be able to know probably, is it about risk or is it about the return that people shy away from the other products and just go to money market?
I think I will take every single category of basically the unit trust in turn. Then I think I can be able to just explain very briefly. So for the money market fund, it's very popular in part because it's basically geared towards individuals who have a low risk tolerance, if at all I may put it that way. So technically speaking, the bulk of the investments are actually made in short-term interest-bearing securities. And so you may actually find that one can actually be able to look at basically government securities. One can look at call and fixed deposit banks. One can also be able to look at commercial papers. So typically the rates tend to be relatively stable. They tend to be inflation beating, and they are very easy to actually explain to the ordinary individual. For fixed income funds, they tend to be for individuals who, let me say, have a medium investment horizon. In other words, someone who potentially may want to put money away for, let me say, anywhere between, let's say, 3 and 5 years. And typically, the underlying investments tend to be short to medium term in nature. We actually find that the bulk of the investments tend to be government securities with, let me say, anywhere between 3 and 5 years. As a result of that, this is for individuals who want to basically have exposure to some government securities which are a bit longer dated. And therefore, that actually means that a particular client that would have a slightly higher risk profile. But for the equity funds, they are especially geared towards individuals who have, let me say, a higher risk appetite, individuals who basically want to just grow their net worth by just exposing themselves to, let me say, the volatility, which actually comes with investing in the equity market. So I think this is something that is actually very common. I think the only challenge that we've actually seen in Kenya in particular is that the markets tend to be very volatile, right? So you don't exactly have success with individuals that's buying a stock and just holding it for around 10 years, in part because the bulk of the market participants are foreigners. So whenever they're quite heavily involved, and of course the prices go up, if at all they don't, then of course the prices either remain stable or they go down. Clearly, equity funds are geared towards individuals who basically have that higher risk tolerance. But then again, they're more popular abroad, especially where their stock markets and their security markets are basically geared towards greater participation in basically the equity markets. I think for the balance funds, again, as the name suggests, so one is actually trying to strike a middle ground between equities and fixed income, let me say interest-bearing securities. But again, as one observation that we've been able to have, especially as Kuza, is that we've actually been able to see that over time, a buy and hold strategy does not exactly give the very optimum, let me say, return that one would actually get from just holding a money market fund instrument. But then again, maybe to just give some insights on how we actually approach some of our unit trust products is that, for example, you have a momentum fund. So essentially what the fund does is that it exposes itself to basically securities which have the highest potential return upside. So they could be equities, they could actually be fixed income, or they could actually be, let's say, for example, any interest-bearing security that the regulator would actually want. And I think this is actually very important because it actually helps us to be able to position ourselves based on the market dynamics in the country. So in a nutshell, if at all you're, let me say, short-term and a low-risk investor, money market funds work for a person. If at all one is actually interested in taking up risk, then clearly having a bias towards an equity fund or a special fund, which potentially has higher risk, is a way to go. For a balanced fund, it could actually be theoretically very good, but as you've seen, it may not exactly perform well because of our equity market. So hence the reason why different players, including ourselves, are trying as much as possible to have very good options, such as the momentum fund, so that at least one could actually be able to get a better risk-adjusted return as opposed to just having an equity fund only. So again, that's how we actually think about it. And at least we try and cater to every single person, the risk spectrum from the low-risk investor all the way to the high-risk investor.
Maybe you can tell us more about how momentum fund works. And we know Kenya is mostly geared towards something that is trending. There's a lot of hearsay here and here, especially with the social media. And could this be probably also that money market is more common because of its trending nature? And because sometimes we've seen people going to money markets, but then after a short while, they're disappointed of the kind of returns. They want higher returns probably, and they were not aware of. They just got in because of how it's trending. It's common. People are being told, you put money in your money market. It's been compounding interest and all that. But that's because we are not so much aware of the other products that are there. Like Wilson had started mentioning about active equity funds, which we will look at what's the difference between active and passive a bit later. But can you tell us more about the momentum product that you said is in between equity funds and money market funds? That's on it a bit.
Okay, so I think I'll first touch on the very first observation, and then I can respond to the question in turn. One of the main reasons why Kuza was actually established is because we realized that there's a significant financial literacy gap. And again, to your point, individuals basically are exposed to only the information that actually gets to them. And that's why, even as our name suggests, we try as much as possible to nurture individuals' financial journey so that at least they could actually be able to get more information and they could expose themselves appropriately. But I think one key driver that actually determines, let me say, investors' financial decisions has to be generally their ability and their willingness to take risk. And so one's ability to take risk predominantly is determined by their net income or their net worth. So technically, someone who basically has a much more stable income and potentially can be able to predict it may want to expose themselves maybe to something a bit more volatile, in part because they can actually be able to take that risk. But at the same time, you have individuals who basically just want something which can be determinative and then Hence the reason why, for example, the money market funds could actually be very interesting to your point. Now, for the momentum fund, so it's actually a special category of product. And again, according to the CMA, allows for particular carve out, especially in investment product known as a special fund. So essentially what that connotes is that the fund manager has the leeway to basically invest in securities that, let me say, may not exactly be categorized using the usual definitions of, let's say, for example, of a money market fund or an equity fund or basically a balance fund or a fixed income fund. So the way we actually do it is that we tend to have quarterly capital market expectation sessions. In other words, we sit down as an internal team, we try as much as possible to basically determine some of the economic and, let me say, geopolitical or political waves. And then what we try and do is we try and expose ourselves to the asset classes which potentially could be able to ride on this expected momentum, especially from a return standpoint. So this year, especially, we've actually been very successful with investing in equities because that was actually our expectation at the beginning of the year. So at least that effectively has actually borne itself out. But of course, as time goes by, we definitely look for some of the asset classes which are really good. For example, going forward, our expectation is that fixed income securities will actually do well, in part because interest rates have started coming down. So clearly, that is something that we can potentially do. Now, as I actually highlighted, and maybe this is a final thing I'll say before maybe I hand it over back to you. So the momentum fund is for individuals who basically have a higher risk tolerance, in part because of some of the daily oscillations that actually come with some of these positions. And hence the reason why we actually have a minimum 6-month lock-in period, which effectively just allows for some of our investment pieces to effectively play out. So this is actually geared to individuals who basically have that higher risk tolerance, but at the same time, they definitely want to expose themselves to particular an investment option. So again, depending on the client's specifications, the money market fund could work for them. The fixed income fund could equally work. Also a momentum fund would also work for them, just depending on where they are and what exactly they're trying to do just in their lives.
Okay, thank you, Bill, for that. Is Wilson back with us? Manuel?
Not yet.
Bill, you've actually touched a bit about, it was supposed to be my next question actually. How do you, as portfolio managers, determine how to invest people's money? Like I'm coming in to invest into a money market fund. I'm coming in to put money into a momentum fund. So how do you make investment decisions to ensure there's preservation of investors' capital and also try to maximize the return that they are able to get and mitigate the risk that may be coming with the type of unit? What is the process of deciding that as a portfolio manager?
It's a very good question, which is actually asked a lot. So again, I'll first start off with a general principle. Given the fact that we actually take in public funds to invest, we're actually guided by the CMA regulations. So essentially what that does is that it actually provides us a framework or a blueprint from which we can actually be able to start even making investment decisions. So in other words, for example, you may find, especially across the 4 unit trust products, and I think I'll just briefly start with the money market fund. So essentially, according to the law, we are only mandated to invest in interest-bearing securities. And so the regulators has actually specified the maximum, let me say, positions you can actually be able to take in those particular, let me say, positions. So essentially, it would now be our job, based on our expectations and based on the experience that we actually have, to now take positions which effectively would be in the interest of the client, because ultimately, we have a duty to ensure that the client or the clients in general get the highest possible return while actually taking the least amount of risk we can actually be able to take. So for example, when you look at the money market funds, let's say we can actually be able to get a very good position in a government security, which is yielding, let me say, around 18% or 18.2%. So we'd actually get into that. For example, we are dealing with a bank and we can be able to get a very good fixed deposit, which potentially could actually be, okay, let me say that rate could actually be even double what the average customer is getting. So we'd expose ourselves to that. If at all we see a commercial paper which we actually believe is very credible, we can actually be able to expose ourselves to that. So in essence, we follow the guidelines which should actually be given by the regulator just in terms of the maximum caps across a variety of securities. And then again, we try as much as possible to ensure that we make investment decisions which are actually in line with the client's general interest. Again, maybe to just say something which I suspect you are hinting at, and I think it's important to disclose. So as a fund manager, we actually are part of an ecosystem. We're not the only players in this particular ecosystem. By that, I mean, we have a trustee who effectively assumes the role of the owner of the fund. So the trustee effectively is a one who oversees the work that the fund manager effectively does. And this is something that the law has actually stipulated. At the same time, you have a custodian, which typically is a bank, which actually now houses the funds, so that at least you actually have all these 3 corporate individuals who actually work in tandem to actually ensure that the mandate of the fund manager is effectively met. So at the same time, there are quarterly reports which are issued to the regulator, especially by the trustee, to ensure that we're actually in line with a particular mandate. And again, on an annual basis, we have an annual general meeting whereby all the investors who've actually been able to put their funds can be able to look at all the reports of the fund manager, of the custodian, and of the trustee, as well as the auditor as well, so that we can actually be able to have, let me say, very good transparency concerning what exactly we do. And maybe lastly, on this particular point, we also have an annual audit by the CMA, whereby the regulator comes, typically sits with us even for 1 week, and then they comb through everything to ensure that we're on the same page. So in other words, we have those guidelines that are stipulated by law across the money market fund, the equity fund, the fixed income fund, the balance fund, and also the special funds. And at the same time, we are subject to oversight by the trustee. We also are subject to oversight by an internal board. And at the same time, we also have a duty to the regulator as well. We do our very best to ensure that our returns are very attractive in order to ensure that our clients get value for their money.
You talked about how you manage funds on the perspective of fund managers. As we keep on improving our financial literacy and teaching people about financial literacy, sometimes we find that investors have a hard time to actually even have the right questions as fund manager. If they want to invest into a balanced fund or a money market fund, investors sometimes don't have the right questions or the right words to put across. But we can actually look at what are some of the indicators as an investor they can look at when they're trying to assess the performance of users. What are some of the things they need to look at to interpret the metrics so that they know this is the best product for me, this is probably momentum or money market? What are the things they need?
That's a very good question. I'll put it this way. I think maybe there are two ways in which you can actually be able to assess how well a fund manager is actually doing. So number one, on a daily basis, the latest returns or the latest yields of all, especially the unit trust products, are published in the dailies. These typically are ranking that any individual can actually be able to do, or there are some companies which actually do. So that, again, you can actually be able to see the ranking of all the fund managers, let's say, for example, per product. So I know, for example, when it comes to the money market fund, there are around 25 players. And the most important thing is to basically say, okay, it's fine. Relative to the other players, how well is, for example, Kuza doing relative to the others? Because at the end of the day, a client would want the highest possible return while actually taking the most appropriate level of risk, not necessarily exactly the smallest, but the most appropriate level of risk. But of course, when it comes to money market funds, the return typically is relatively high, but at the same time, that particular risk profile tends to be a bit low. So in essence, these particular return comparisons are there, especially on a daily basis. One could actually be able to go and see what exactly is actually published in the daily. So that is something that is actually there. But at the same time, depending on a particular, let me say, fund manager, there are typically aspects known as benchmarks. So in other words, we typically provide a return, and then we actually say that this is the measure in which you can actually be able to now use to actually assess whether or not you actually beat another particular benchmark. For example, when you look at the money market fund, our particular benchmark is a 91-day T-bill. So essentially, whatever rate we are actually providing, one should actually ask themselves, okay, is it higher than the prevailing 91-day T-bill? That's how you can actually be able to tell whether or not we're doing a good job or not. For example, for the fixed income fund, one should ask, is the particular return higher than, for example, the 5-year government treasury yield? So at least that way you can actually be able to identify from an industry perspective, are we doing as well, or are we doing better than our competitors? And then similarly for the benchmark that we've given you, are we actually meeting it or are we beating it? So at least you can actually be able to see, okay, you know what? At least these people are actually acting in line with their mandate. So I think those are basically the two ways in which you can be able to assess whether or not a fund manager is doing well or not.
Okay. So as a portfolio manager, how do unit trusts offer diversification? And what's the advantage that unit trusts have over probably the other asset classes in the market?
That's a fantastic question. Allow me to just step back and provide some perspective, which I think will help us even as we're answering the question. So essentially, a particular investor should actually focus a lot on diversifying their risk. What does that mean exactly? One should actually try as much as possible to expose oneself to asset classes whose returns are not necessarily, let me say, conjoined. By conjoined, they don't necessarily go up together or they don't exactly go down together. So in other words, you actually need to expose oneself to a basket of securities so that at least from a risk perspective, one is effectively covered. So again, looking at every single individual's, let me say, journeys and just from where they are, just from their level of, let me say, sophistication or from basically their state of employment, for example, or their age, the first thing we actually do is to try and make a risk assessment. And then we ask ourselves, okay, it's fine. So based on these client specifications and where exactly the client is and where exactly they're going, so what potential asset classes do they have right now? And how best can one be able to get a basket of securities or assets which effectively could actually be able to help them get where they actually need to get to? Now, To answer your question about unit trust tend to be very important, especially because they actually offer something that potentially one may not necessarily get. For example, if at all one just puts money with a bank, one actually has the potential of getting significantly higher returns than if at all one would actually be able to just put money in a savings account, or for example, in even just in a current account, so that at least one could actually be able to ensure that if one looks at the overall portfolio, one is actually doing much better than if at all one actually had those funds. The reason why I'm actually saying this is because one cannot, for example, have 100% of their assets, for example, in unit trust. One potentially may have 40% in real estate, maybe 30% in another potential asset. It could be a business. And then let's say, for example, the amount of money that you actually have, which is liquid, maybe that's the one that effectively one should actually potentially thinking about putting it, for example, a unit trust. But the most important thing we really try and do is we try and look at the client's perspective and ask ourselves, okay, based on the client's current asset allocation or asset mix, so how best is a client positioned to actually achieve it? Especially for us, we believe every single person should actually have a decent amount of unit trust, because we actually think of it as, especially for the money market fund, as effectively an emergency fund, so that in the event one actually has a significant event that actually requires liquidity, one could actually be able to draw down on it. In essence, what we try and do is we try as much as possible to have a very balanced perspective. Hence the name Kuza. We try and assess where exactly our client is. And definitely we understand that client would want liquidity. And we definitely want that liquidity with us or with any other fund manager. But of course, we would actually prefer Kuza Asset Management, so that at least we can actually be able to ensure we are giving very good inflation-beating returns, so that even by the time our client is even making a particular investment decision, it's actually made with the realization that they could actually be able to get the highest possible return at that particular moment. And then again, we can actually be able to work with them, especially on this journey, so that at least we can be able to grow. So in essence, we try as much as possible to focus on diversification, but we try and have a discussion with the client, and we realize, okay, if at all a client wants to invest in the short term, money market fund and a shilling would be good. If at all the client has a medium-term horizon, we look at the fixed income fund. If at all the client definitely wants to have a bit more risk, we can actually look at a momentum fund. So essentially, we try as much as possible to tailor-make whatever choice that the client would actually have to their particular investment circumstances.
I see which one is back with us, but I want you to ask one in the works for you, Bill, a little bit. So, and this could be probably an ethical perspective. You have this client who comes to you and you explain about the money markets, the other funds and all that. And from the understanding of the client is that probably money market will not give the best return after the expectations. But your analysis says that this client is not able to take up the risk that the kind of return that they want to align with the analysis of this particular client. Then how do you again now handle this client who wants better returns but is not able to accommodate the risk analysis that this client is not able to take up this kind of products? How do you handle such a client? How do you ensure they get the maximum that they need?
Very good question. And again, I think I'll just go back to a very important principle, and then I could actually be able to highlight some of the ways in which one could actually be able to go about this particular dilemma, right? So essentially, as a fund manager, we have a fiduciary duty by law to ensure that we act in the very best interest of the client. And I think the reason why we insist on this is in part because ultimately our main role is to actually ensure that the client's investment objectives are met, because at the end of the day, that is what potentially will actually help us not only retain the clients, but also not only grow our business and also grow our brand in the future, in part because we are actually a going concern. So we would not necessarily want to jeopardize a relationship with a potential client at the expense of our reputation taking a hit, and yet as a business, we actually have a continuing interest. So I think maybe that's just something that potentially we can actually be able to just put in that way. But then again, this particular discussion is actually concentrated on unit trust. But then again, as Kuza, for example, we have 10 other products, which to your overall point could actually be able to meet some of the other risk specifications. And then again, it's very important enough for us to say, okay, now based on the products that we have, how best can we actually be able to meet these client specifications? And at the end of the day, we will provide a recommendation that is not only in line with what we definitely can be able to objectively determine is a way forward, but at the same time, we'll try as much as possible to also just guide them accordingly, so that even if they're not exactly where they are as of right now, we can actually be able to help them walk with them on this particular journey, not only on their own, but if at all they want to do it as a group, you can do it as a chairman, you can do it as two friends, you can actually be able to do it as a group of 15 or 50 individuals, so that if at all one person wants to take that step, and then able to potentially other individuals could actually be able to come and actually help them get to the particular desired destination. So in other words, to your point, I understand that there is actually the temptation to just say, you know what, you actually want the client to come on board. But at the same time, what we typically try and do is remember that we have a fiduciary duty to the client, and we have to do very best to take care of the client's interest. But at the same time, we definitely have a goal to actually ensure that especially our company lives beyond us. So essentially, we want to ensure that at the end of the day, we give the very best investment advice so that at least we can actually be able to ensure that at least our clients are actually content. And also the regulator by extension is actually content at the same time.
Thank you. Thank you, Bill, for that. Answer integrity very important when you're giving money to an institution. Integrity is really key. So you dropped off when you were explaining to us about active equity funds or something of the sort. So you can just pick it up from there and tell us, what is this active equity fund, or what is an active fund for us in comparison to passive funds? We probably are not even aware we have active versus passive unit trust funds. So you could just tell us what is the difference between active and passive, and then tell us why, in particular, as AMCOP, you wanted to concentrate on active funds.
Probably just to build on what I was explaining about the active investments and passive. So I was explaining that we looked at the market, how it's structured currently. And there are these opportunities or pockets of opportunities that clients, they come saying that, okay, we are looking for this active, or we are looking for this level of return. And at times in the market, on what we found in the market, that there are no active equity funds. And I was explaining that at Avocap, we have 3 sets of equity funds. We have a Zaman Equities Fund, which is a Kenyan Equities Fund. Then we have an African Equities Fund, and we have a Global Equities Fund. And how we looked at it was like, one, in the local market, there is volatility within the market itself, the movement of the shares prices. But investors may not be in a position to actively look at what the price of KCB doing, what's the price of Safaricom doing, which are the market labels, which are the technicals to look at these markets. But now for us, we have this team of research analysts and specialists who are actively looking at these markets. But beyond that, we looked at now, if an investor comes in and they are looking to invest in the share market itself, then how do we diversify their risk? How do we diversify even their returns? That's how now we looked at like the African market itself, that from a strategy perspective, if we are investing in telecoms as a fund, in Kenya, we are only exposed to one company, which is listed as a telecom company. But if you look at the African market itself, we could be now diversified into MTN, it could be Moloch Telecom and such. And so it means that now as a strategy itself, if we are still allocating our 10% of capital to telecoms, we have more to choose for. That even when the local telecom is not doing well, these are the African telcos that are doing well. And so basically what we are doing is we are diversifying returns for clients, that you're not exposing them to just even our own macro risks. And that's the beauty about now active investing, that you're looking at where are these opportunities. And if the opportunities are not here, then how do you look for the opportunities where they are? Then when you look at the global markets, as well as explaining that for the global markets, you look at a client who is looking to invest million shillings or $10,000, 1.3 million shillings. And they're looking to invest into, if we went to the global markets, you'd probably buy just less than 40 shares of Microsoft. So you have invested 1.3 million into just one company just to buy less than 40 shares, and you're exposing yourself to the volatility of this one company. But now with a collective investment scheme, so we have created this pool, we have these value businesses, 15 to 20 value companies, that as an investor, you are exposing yourself now to with a minimum of $1,000. Because for our global equities, the minimum is $1,000. So the $1,000, you're getting yourself exposure to over 15 to 20 high value companies. So you have diversified your risk. That's one. And then on the other side, you have also diversified your earnings. So your volatility, basically it's reduced the volatility of your earnings. And just to explain a question he had asked me earlier, how do we look at active management within the collective investment, and what is a collective investment scheme? So for us, it's about pooling these clients, and also in terms of pooling, because they have the same investment goal or investment strategy, they are looking to invest in the shares market. But then how do we create opportunities for them, one, to diversify their risk, reduce volatility of their returns, but at the same time, aim for above market on really good returns. So basically, that's the strategy that we use at Avocap. And that's why now from our active management space in the equities market, you as an investor will come to us, tell us you are looking to invest a million shillings in the shares market. We sit down with you, look at your risk levels, look at what are you aiming to achieve. And probably now we'll come with an allocation, let me say of 40, 40, 20, 40% in local, the money equities fund, 40% in the global equities fund, and 20% in the African equities fund. So you're still invested in the space that you are interested in, that's the shares market, but you have diversified in terms of your allocation. You have diversified in terms of diversity of what you are investing in. You have reduced the overall volatility of your portfolio itself. And that's the beauty of now investing in these collective investment schemes, that they help you to achieve more They help you to get higher returns, but at an aggregate without increasing the risk level that you're investing into. When we speak about active investment in the bonds market, for example, if you look at the bonds market itself, so most people, how they invest is you go and buy bonds and hold waiting for the coupon. But we realized there were fundamental issues within the bonds market itself. One, investors that are coming with small amounts of money in terms of liquidity to get in, get out. You find clients trying to, with 2 weeks, 3 weeks, trying to sell their bonds because they have less than $1 million or they have $1 million. They still can't get buyers of these boards. So how do you create a pool for clients who want to be active in this board space itself to give them that avenue? So at Avocap, what we did in our fixed income product, we created the products. One, we created what we call the GAO fixed income distribution fund. Fixed income distribution fund, basically as it says, it's a distribution fund. So people invest in the bonds market for, let me give you an example. For you are like, okay, I want to take care of my rent is 20K or that K. So how much do I need to save to get, I know that I've taken care of my rent or have school fees of 100,000 shillings. So how much do I need to invest? So I know that every quarter I have 100,000 shillings coming in to take care of my school fees. So we created a GAO fixed income distribution fund. So that one distributes income to clients. It has 4 classes: monthly, quarterly, semi-annual, and annual. So it distributes within these classes or within this frequency. But at the same time, there will be this client who, for them, they have their rent sorted. They have other sources of income. So they are not so much worried about the income, but they want to invest in the fixed income space. They still want to get the government, so they don't want to take too much risk in the equities market, but they want an active return or they want a high return. So Avocap Asset Managers created the Almasi Fixed Income Fund. It's an active bonds trading fund that now, instead of just buying bonds and passively holding them in your books, then you can actively trade your bonds. And you got you have these clients who like, okay, I'm getting 18%, but can I get above these within the bond space itself? You are not moving outside your risk metric, but you're aiming for a higher return out of that. And so there are these opportunities, and that's the beauty about now looking at fund management from an active rather than a passive way, but with an active strategy. So like for Almatic Fund, now you'll actively be investing in the board market, looking for these opportunities, looking for the mispricing within the boards. Our research analysts, our macro research analysts, they'll be doing research on the yields, research on everything, the market volumes within the market itself, and looking for these strategies to help make an extra return. And out of that, we find that now above what the normal board will be giving, we are delivering 4-5% above that. And so if you see now a client is getting a higher return within the board space itself, so they have not added any risk towards their portfolio. They're still within the boards market itself. But now what they have done, they have changed strategy. Instead of passively holding bonds waiting for a coupon, their bonds are actively, or they have invested in this collective investment product that is actively traded, so giving them a better return. And so basically now for us at Avocap, when we look at active strategies, so that's how we look at it in terms of how do we solve this. And the other issue with bonds was the liquidity. Now we see it in the pooled investment products. It's for you to just buy units into the fund itself. So when you want to exit, you just come and sell your unit. So you're investing 2 million, 1 million, 500,000. So you just come and sell your equivalent units. And with a pooled fund means that probably you are selling to someone who is entering the fund at that particular point in time. Or it's easier for the fund manager to actually sell a bond than it is for you as an individual client. Or probably you are using your coupons to get that alpha return from your coupons that I have. This board portfolio that I already have. So I want the coupons that are being paid to invest in this active fund that will actually now give me a better return for me to achieve a higher yield of my whole board portfolio. So for us at Avocap Asset Managers, when we look at active strategies, so basically that's how we looked at equity. We looked at the local equities market, the African equities market, and the global equities market. How do we help clients to get access to them? In the bonds market, we looked at the GAO for income distribution. How do we help clients who are saying, okay, I want this level of income? For me, Nataka, once I get 30K per month, I cannot concentrate in other things because I know my rent is sorted. Or I want 50K for upkeep or 100K for upkeep per month or per quarter. So that once I save towards this and I get in this income monthly or quarterly, to pay my school fees, then I can concentrate on other investments. And that's how it's a GAO. It's a shield. You just takes your money away. Or I want to actively trade my bonds portfolio. That's the massive income fund. So when you look at active or collective investment schemes, all our bonds, all our dollar USD fund, what we call the Euro Fixed Fund, you want to invest in the Euro bonds market. The current, and I think this is a good example of what a collective investment scheme can achieve. The Euro bond currently, one Euro bond is $200,000. So as an investor, if you went to buy, you need the $200,000 to buy the bond. And so probably you're earning in dollars or you want to keep part of your wealth in dollars. But now you need to accumulate $200,000. But come the Euro Fixed Fund, with $1,000, you can get a piece of the Eurobond. So basically, you're democratizing access to the dollar fixed income market using now our collective investment schemes, or like the Euro fixed fund that we have at Avocap Asset Managers. And so for us, we look at now active management of collect or CIS or the unit trust schemes. So basically, this is how we looked at it. And these are the gaps that we saw that there are opportunities. Clients are learning in dollars. They want to invest. They want government risk. They don't want a lot of risk, but they want it still in dollars. They don't want to sell and come and buy bonds. So how do we give them access to the Euro bonds? The Euro fixed fund came in to fit into that. So for us, just in a nutshell, look at active management or the opportunities that are there within the fund management space itself for active management. So looking at what is the client need, then how do we solve that client need through an active strategy? Then we created products that meet these needs.
So you've touched quite a number of things in a short span of time. And now I'll try to just take you back on a few things. But before we do that, you can also send in your questions. So you'll be able to go into the questions one by one and ask anything that you want, either Bill or Wilson to touch on it. Wilson, I want to stay with you for a moment. And being new kids on the block, we definitely gonna ask you a lot of questions. We have to ask you many questions, especially pertaining the products that you have on board and you are bringing to us. And you mentioned quite a number of things about them in terms of distribution, advantages, and in terms of diversification and all that. And you mentioned something like you also investing the funds into other markets other than just the Kenyan market, from what I understand, but you tell us about that. If you're also investing into other markets, then this definitely means like you just exposing the investors into a broader market. And probably there are people who may not be able to be understanding this market, and that's why it's an active fund anyway. So that because you professionals are actively managing these funds. But as a person who comes in and gives you money and I do not understand this market, how do you make your investment decisions, especially knowing that you're also related by the CMA? How do you ensure that my interests are well kept? You are exposing me to other markets, but you're also trying to keep the integrity that you are also protecting my money. How do you make your investment decisions?
Okay. One, in terms of our investment decisions, so we have an investment policy guideline on each of the funds. So one, the first part is the interaction with the client. So for us, we said we are looking at fund management with a wealth advisory perspective, that you'll come to us as a client, tell us that, okay, this is my investment goals and this is what I'm trying to achieve. I want to invest in the shares market, and this is my goal towards that. Or I want to achieve this and this. From there, we'll help you build a portfolio that, okay, you actually need first to create your emergency. You need to this pool of funds that you can easily get access to. So that's your money market. Then you'll be saying that I'm looking to achieve this level of income flows. So we'll advise you and walk you through now how to invest in so what are you looking to achieve? Which need are you looking to fill with these income flows? And what is the frequency that you need this income? So we say, okay, probably I'm looking to pay school fees. I have this level of school fees that I pay every now and then. So I'm looking to this passive income to be paying the school fees of my children. So we walk you through now the GAO fixed income fund, okay, quarterly plans for you to get that income flows. Then on the other side, you say, okay, now I'm also probably looking to have this plot of land and I'm looking to build. And my quantity survey has given me a valuation of 5 million or 7 million to build my house. And so in the next 3 years, I'm saving towards this goal. And so we walk you through that. Now, how do we help you to achieve that within this period, the amount that you'll be looking to invest? How do we help you to achieve that goal that within that period you have achieved your target of 7 million? So we'll be speaking to you about now the Almasi Fund. Then another client will say, now, okay, for me, I probably have this base of balls, I have this base of land, but now what I'm looking to is this extra return, an alpha return. I want to be in this shares market. I can't actively follow what is happening in, with the banks. They're speaking about NPS and all these. I don't know how to access the level of risk within these spaces. So how do we invest in this shares market? Then we'll walk you through that. This is how now to diversify within the space itself. That will walk you through as a client in terms of the offering, like in the Zaman Equities Fund. We also walk you through how you can diversify through now these other markets, such as the African market or the global equities market. And for each of these funds, what we have done, or as I said, is an investment policy guideline. And what happens is that for us in our firm, our biggest stronghold is the research team and the capabilities we have built within that team. That for them, they are actively looking for these opportunities. They're actively going through the numbers to ensure that even the opportunities we are investing in and the risk that we are taking is within the frameworks that as defined by the IPS itself. Now, there's also metrics that for each company you invest in terms of, the APS has defined that this is what you are looking in a company. What is the operations margin? What is the cash flow yield? What is the market share and this like that. So we have all these defined metrics that we look at into companies that we invest into these markets. And so what our team will be looking at is that, does this company fall within these defined metrics? Its volatility, does it fall within the metrics that has been defined? And once now they have that, then they make the recommendation to the investment committee. The investment committee, the portfolio managers, the CIO, the other executives look at all these, the research notes that have come in, the opportunity that is there. So it will go through a thorough basically analysis that before we even invest, we may like a company, it may fall within all our metrics, but probably looking at the price level, or we're like, okay, we can't buy it at that particular point in time. We also define what is our margins of safety for every trade we are investing into. We love Amazon. We have probably done all the metrics for it, has good market share, has everything and everything. But does it fall within our investable horizon? Does it give us a good margin of safety, the price that you're buying it at that particular point in time? So we go through this thorough analysis of every investment that we are making to ensure that we are making right decisions. One, we're also not seeing a huge risk within the portfolios for our clients. And here the aim is that long-term investing, by looking at these opportunities that we'll get within that space itself. So how do we take advantage of that? So for us, I would say now, from a risk perspective, we are very cautious of that. But the best caution in terms of risk is what goes into before even something becomes, now, actually, this one can be bought, or this one, it's time to sell this. It's time to book these profits. So what has the research team and what has fed towards these decisions? So I think that's what we pride ourselves in, that we are not only blindly trying to get into positions or acquire these shares here and there. We are doing that active, and the activity itself is not what the client receives and what they're buying, the unit price, but also what happens to us in the backside from the research team, from the risk team. Everything has to go through the risk team that, okay, it falls within what has been defined as the scope of this and this. And before now we come to the investment itself. And I think these are some of the measures that make the collective investment case, these active collective investment schemes, better vehicles for clients who are looking to build wealth in an active way. But as I said, the activity itself, as we define the risk, for a client who is looking to actually save it for my house, we start them from the board that even in the board sector itself, where there's not much risk that you're taking, there's actually an active fund that can help you compound for you to achieve your dream of building towards your house and such. So Avocap Asset Managers, that's how we look at it. So work with a client from the beginning, understand their goals, understand what they want to achieve, then walk them through our products, help them understand each of the product and how it can fit towards this goal, and then make now an allocation decision that, okay, let's do 30% here, 30% here, 40% here, and this is the aggregate risk within your portfolio or the aggregate return that you're aiming towards your portfolio. And with that, you're helping clients to achieve their goals, diversify, get better returns without onboarding too much risk to them as the investors.
Great. Thank you, Wilson. And I believe that is a really, really important point that we need to point out to everyone listening and everyone out there, because we don't like engaging the professionals when we are doing investments, even the smallest investments. We really don't involve the professionals into the process until something happens, and then we run to the specific company and ask questions. And when maziwa ilishamwagika au maji ilishamwagika, so it's good to also involve the professionals into your investments. Let them analyze your risk potential. Let them analyze and tell you what product is good. And I think that is what I've picked from Bill and Wilson. When you want to invest into any of the unit trust products, it's good to engage them also, even as you on board online on these products. It's good to also engage someone who can take you through and ensure that you're investing in a proper way. Really, I want to throw this question to you. So in terms of capital, what is the least you can advise someone? You probably have the minimum amount as Kuza that allows people into your products. But let's be real here. If I want to realize some significant return with my money, what can you tell someone that if you have this figure, you can as well just start with the money market or go into an equity fund or something? I know there's a benchmark of where we say anyone can come in because this is the, but most of the time you find that people come in like that, and they took ukweli on ground ni kwamba someone puts in 1,000 shillings and they never top that money up, and they expect the returns to be exponential in a very short time. Sometimes we have to be realistic to ourselves and say we have to be disciplined in terms of saving or investing. So what is this amount that you can tell someone, the least that you as the person here on the lowest level, please, you can strive and have this amount from your salary or something that you can start you off and you can see some significant returns?
Thanks very much, Namsi. I think that's it's a very good question. So again, to just start with a general principle, which I think can be able to guide us even as we are having this brief discussion, is rarely obtained very quickly. And in fact, there's actually a very prominent investor who says how quickly one actually thinks one is likely to get their return is how quickly one potentially could actually be able to lose that upside, because wealth is actually built gradually. And again, one key aspect that would actually be able to determine whether or not one can be successful from a long-term perspective, just in terms of gathering wealth, would be discipline and the ability to just be goal-oriented. Because again, to your overall point, if you're dealing with, let's take 3 quick examples. You have, let's say, a student who basically has just finished campus and they definitely want to potentially start work. So potentially to them, they may actually think that they may actually need quite a bit of money to effectively invest. But again, for example, for us, to actually start with a money market fund Kenya shilling product, you just need 5,000 shillings. We definitely stretch this particular target to just encourage individuals to just make that sacrifice, because that sacrifice will actually engender discipline. And again, if at all one is actually disciplined, at least, because the minimum top-up amount is only 1,000 shillings. So every single time one actually puts in that 5,000 and then one actually keeps on growing, then of course that's how effectively one actually looks and says, okay, you know what, I've actually got a 15, 20% return within a particular year. Now it actually incentivizes to say, you know what, I might as well want to put more money aside and then I can be able to invest. For example, you may have someone who basically just got married, for instance, and then they may actually want to start a family. And now to them, 5,000 shillings may not be enough. So maybe to them, maybe they may start with 50 or 100,000 shillings. Now to them, clearly, the most important thing is now to actually sit down with them and come up with a determinate plan. In other words, we just try as much as possible to say, okay, this is exactly where we need to actually be in 5 years. So this is actually the minimum investment amount that effectively you need to have. Or for example, you have someone who's retired, someone who says, you know what, they just want to have enough money to just take care of the expenses now that, for example, either the kids have left their home and they definitely want to be in a position to effectively just have enough cash to actually beat inflation, and then they could actually be there. So in essence, we definitely would recommend the client would be extremely honest with themselves. And of course, we'll actually help in that particular regard. And would actually advise them to just push themselves to actually come up with at least a minimum investment amount that would stretch them. But at the same time, that should actually be able to give them the discipline to actually keep going on. Because I think to us, that is actually the best way of ensuring that those sustainable returns in the medium to long run effectively come up, because some of the most disciplined investors are the ones who actually end up meeting the objectives. In summary, in a nutshell, we definitely would recommend that whatever amount that one actually thinks at the top of the mind that potentially they could actually be able to have, would actually ask them to just stretch themselves and say, okay, can you get 1 times that? Can you get 2 times that? Even if you're even starting on your own, maybe you can actually start with a few friends of yours. You can start with a chama and say, okay, you know what? We're actually aiming to get to this particular level. So perhaps let's just commingle our funds and then let's actually do it. So in essence, a general principle is try as much as possible to set oneself stretch targets, so that at least even by the time that money is leaving your pocket, you feel it and say, you know what, I'm literally putting this money aside for my future. And then that level of discipline is what will likely come about, because it's very, very rare someone actually gets a lot of wealth in a very short period of time. Wealth is actually obtained from discipline and consistency. So I think that's basically how I would actually advise any particular client.
Thank you. And you mentioned amounts, which is something I think almost all fund managers stipulate on their list, that there's a top-up amount per month. So you mentioned there's a 1,000 top-up amount. This is a dilemma that I also have myself. And I believe that is a minimum amount. But we have people who put in the 5,000 at the start and they never do the top-up for 1,000 per month. Or is there a penalty for people who don't do the per month top-ups? What does it mean when you write on the list that this is the amount of money you need to be putting in as a minimum per month? This is a must. I need to be putting in that 1,000 per month.
Right. Thanks for that. So technically, there is no minimum top-up amount that one is actually obligated to make. One would actually not get penalized. There's no minimum investment amount that one would actually be able to make. One would definitely not get penalized. But we would just urge clients to just try as much as possible to stretch themselves to actually get their targets, but there will be no penalty. No one is going to make it obligatory to effectively make those top-ups. No, but we'll just work with the client to ensure that at least we're helping them be able to get to their ultimate destinations.
You can just tell us what are some of the fees, taxes, and costs that come with investing with the different types of unit trusts that you have in the market. I'm sure there are taxes that are involved, and sometimes we miss tax bits when you're doing your calculations in terms of returns. There are also cost management fees. You can just mention to us what are some of the costs involved, and also maybe after that, Bill, you can tell us in terms of management fees, what are your management fees at Kuza? But you can start with this one.
So thank you, Namse. So in terms of fees, we have, as you have rightly said, management fees. Now, different products at Avocap Asset Managers, different products have different management fees. Our fixed income products, that is the GAO fixed income distribution fund, the Almasi fixed income accumulation fund, and the Euro fixed fund, the management fee is 1%. On the other funds, it's 2%. That is in the equities fund and also on the multi-asset strategy fund. The management fee is 2%.
Per annum.
Yes, this is per annum. Yes. So that is apportioned daily. So that means that now if an investor probably came and bought the GAO fund right now or the Almasi fund, so towards the end of the year, so it means that only for the number of days that they invested in, so that's what they incur. So if it's 2%, probably now, assuming they are 150 days towards the end of the year, so it's 150 over this 64 times that percent. So that's the beauty about it. It's apportioned daily. Now, in terms of taxes, it's different. Like for example, the money market fund and the withholding tax. The money market fund, it's a monthly compounding fund. So that means that every time there's a distribution at the end of the month, there's now the withholding tax paid of 15%. But now the beauty about active management now from our side is that some of our products can be used as a tax savings. So for example, the Almasi fund, the active fixed income fund. If an investor probably you're looking to save for the next 3, 4, 5 years. So it means that now the distribution, your income is still being accumulating every year, but the distribution will happen at the end when you're exiting the product itself. So that means that now the tax will be at the tail end. So that means that at this particular point in time, your investments are getting very decent return, compounding at these high returns. But at the time that you're exiting, that's when the tax, the 15% will be charged on the income. So it means that it's a tax saving, that if you are investing for a longer period of time, some of these products now becomes a tax savings in themselves. So in terms of cost, if you look at the general cost of the CIS on our products and you compare it to even sometimes clients going in the market directly themselves, but for us, it's actually cheaper. For example, if you are just coming to invest in shares in the equities market, you came and just bought it within the fund itself, that your fees or management fees is 2%. But if you went to buy yourselves, now there's these brokerage fees that you are paying for as you enter into the market and when you exit in the market. So on a long-term basis, you find that now it becomes more cost effective when you look at time in terms of cost to invest in the funds themselves. And whereas you're also now looking at professional management, so better returns within the market itself. So I'll say generally invest in the unit trust scheme. It actually could be a tax planning strategy, but also be lower cost. When you look at it, it's probably lower cost for you to manage your investments.
Great, thank you. Maybe you can just mention to some of your management or professional fees that are applied to products at Kuza.
Sure. I'll quickly take you through our unit trust products and I'll just name them very briefly. Then I'll be able to give you the attendant fees. So for our money market fund Kenya shilling product, the fee is at most 2%. So you use the words at most very deliberately because it doesn't mean that we have to get to that particular level. So again, that's just dependent on what you actually think we need to actually do, especially for our clients. Similarly, for money market fund USD as well. So that's basically our dollar money market fund equivalent. So there as well, the maximum percent fee applies. And to just clarify as well, it's an annual fee that effectively is actually charged, especially on a daily basis. And that is actually removed from basically the returns that we actually show our clients. So hence we actually try to be very competitive. And we try as much as possible to focus on predominantly tax exempt securities so that at least by the time one is actually receiving their return, then clearly it's actually much, much higher as opposed to investing in securities which tend to be liable to be taxed. For the fixed income fund as well, maximum 2%. And again, I think that is something we actually do deliberately because we definitely want to work with clients and actually be with them where they are. But again, maximum is actually 2%. To just clarify for all those three funds I've mentioned, all the returns we actually present the public are net of fees. So whatever returns one is actually seeing a net of fees, but then again, they are gross of withholding tax. Then we have two other unit trust products. We have the Momentum Fund, which I highlighted. Maximum fee is at most 2%, as I've actually highlighted. But then again, this tends to be a very strategic product in such a way that we try as much as possible to be very tax efficient with a view to ensuring that clients definitely meet their goals. Because even how we go about investing has to take in consideration this particular amount. But lastly, and I think this is something that perhaps I should have mentioned at the beginning. So we have a Sharia Momentum Fund, which is actually geared towards individuals who are basically of the Islamic faith. And for this particular product, the management fee is maximum at 2%. And this is effectively geared towards any single individual who basically believes that interest is haram or potentially speculation is not exactly good as well. I think that is something we do. So again, these are basically the maximum fees that we've actually been able to highlight. So essentially, that's what we've actually been able to disclose to the public. But again, depending on what we actually think the right fee is, of course, we definitely know that at most it can actually be 2%. And again, all the returns we try and give a net of them, and we try and be very aggressive in a very efficient way so that at least we ensure that our clients can be able to meet their goals.
Thank you, Bill. I see time has really moved and we are almost closing up. But before I go to Wilson, you will answer for me the last question. But Bill has mentioned a very critical point in terms of looking at the returns that are posted out here. Once you come across the returns that are posted, it's good to understand if they're either net or gross of fees, and also if they're net or withholding tax. So that's a point that is really important. Thank you, Bill, for highlighting that. And then, Wilson, before we round out, you could tell us what are some of the macros that actually affect unit trust out here? What are the economic indicators that investors should monitor that are likely to influence unit trust investments?
I would say it's dependent on the asset class that the unit trust product is actually investing in. So, for example, which are the macros that we look at? In our products, they are categorized into four. We have the equities products, we have the fixed income products, we have the multi-asset strategy product, and then we have now the money market. Cutting across, further now, if, for example, you are investing in the bond here, and you'll be looking at what is the economic situation, what is the economic performance. You look at all indicators from the government revenue, from the government expense, from the interbank market rates. So how will the interest rates be? Basically, how is interest rates be moving probably in the next 3 months, even the next 6 months? What is the interest rates expectation? What is the expectation on inflation? And how are these things going to affect the positioning or liquidity flows? So basically at that point, you're looking at how will the liquidity flows within the market be affected by these macros? Now, when you go deeper into now like the fixed income products themselves, you're looking, okay, for the interbank markets themselves, for the liquidity within the banking space itself, the liquidity between the performance of the current yields of the bonds in the market, and where are the opportunities within this? Which are the macros that are affecting the movement of the yields? Like when we had this, something to do with the finance bill, and you saw the yields spike a little bit, but then they cooled off. So how will those impact the movement of such? When you go to the global equities, like in our global equities fund or our multi-asset strategy fund, we'll be looking at, okay, how is the global economy? How is the global interest rate regime? Which, based on now where the specific companies that you have invested in, what is the macro environment affecting in those areas? So I'll say it depends, and also from asset class to asset class. And for us, that's why we say that we looked at it from a perspective that when the risks are not the same across this asset class. So which are the strategies that can be adopted within a certain specific asset class? So it becomes easier to monitor within it. Like in the fixed income market, if you're looking at the Euro fixed fund, it's a dollar denominated USD fund. So which are the macros that will be affecting this particular fund itself based on where it's investing in? Then how do you mitigate depending on the movement, or how those macros will affect the movement of the particular asset classes that you're invested in? So, and at times I would say now, this is where now, let me also give probably as I finalize a simple example with our multi-asset strategy fund. We call it a global themes fund. And I think we have seen over a lot of global currency brokers probably setting up in the country itself. And investors have been trained to trade crude oil, they're trained to trade FX, they're trained to trade all these things. And the risks, we have heard the stories about the risks in that market itself. But for us, as a global themes fund, we look at these markets and the global markets as a thing. For example, if we look at the AI theme, we'll be looking to trade the AI theme in so many different ways. We could be buying the NVIDIA, the share that they lead within that AI space, or you could be buying an ETF in it, or you could be buying a material, a commodity, or materials that are used in the chip making and things like that. So it's basically a broad scope, way more nuanced strategy in terms of investment or the investment thesis that goes into that. And so based on that, now what you are doing, you are avoiding taking these bright investments. You're also diversifying in terms of risk. It's a certain strategy, and you're avoiding the risky area, which are the themes or which are the macros affecting that. If it's in energy itself, which are the macros affecting that energy space itself. So that's the beauty about what we do at Avocap Asset Managers, that our active strategy, what means that every fund that you invested in, if it's a multi-asset strategy fund, those assets that you're invested in that multi-asset strategy, thorough review of what is affecting each asset class. If it's in the equity space itself, which are those factors that may be affecting, we have banking positions, which may be affecting probably in the African equities market. So where are these positions in? Could be in South Africa, which are the macros affecting that particular place. the election cycle, the redemptions, and also the basically positive economic outlook now with the new collaborative government. So how will that affect the counters that you have been invested in? And so based on this, now we help mitigate the risks that may be born out of these macro issues. So yeah, so I'll say it's asset class to asset class. And for us, given how each of our 10 funds is specific towards the asset classes that they invest in, then it becomes easier to follow and also to mitigate the risks that may be emanating or that may be affecting each and every fund.
Thank you for that elaborate explanation. And for sure, it's analyzing macros is not an easy thing, especially can be tricky and hard and time consuming for someone who is especially not having a finance background. And that's why we have people from institutions like Kuza and Avocap for such purposes and such kind of information to us. So as we just close up, this one we can just finish by a short roundup of what Avocap does, what are their main products that someone can look at, and how can they find you if they want to invest into your products. And then Bill, you can tell us the same of what Kuza Asset Management does, what are your products, and how can we find you if we want to invest into your products. Is that with you, Winston?
Thank you. Thank you, Namsia, and also thank you to Mongo Capital for providing this platform where we just take through investors what unit trusts are and how they could actually fit in the investment goals. At Avocap Asset Management, we have 10 products. And as I have said, divided into 4 classes. We have equity funds. We have a Zamani Equities Fund, invest in the Kenyan market, in the NSC shares. It's an active equities fund. We have the African Equities Fund. We have the Global Equities Fund. And we also have the Global Sharia Equities Fund. So basically, that's the ethical investing in the global markets. So what we are aiming to achieve with that is help be more active in the shares market. They don't have to give up about the share market. There's opportunities there. And we build the tools that enable them to participate in that. Then you have our fixed income markets. At Avocap, we have the Avocap GAO Fixed Income Distribution Fund. This is a goal-based fund. Monthly, quarterly, semi-annual, and annual. We have very good tools. We have GAO calculators. So whereby we just be aiming to get that K per month. So how much do I need to invest in? So we can work with you on a plan that in the next 2 years, this is what you need to save to get to this level. And then from there, you'll be getting these income flows. So that's the beauty of the tools that we have created to help investors do that. We also have the Almasi Fund, the active bonds trading fund, which I may say that has delivered very good returns. Did for the first month, did 2.01%, second month, 2.35%. So you can see it's 4.36% within the first 2 months. And that's the beauty of active trading, that you're not taking more risk, you're still within the board space, but because of the active activity in it, you can deliver high returns for clients on the Almasi Fund. Or the Euro Fixed Fund, which invests in the USD, that you have dollar income, you want to invest in the Eurobonds market. Now we have a fund that is just with $1,000, you can actually take a pie of a basket of the Eurobonds. That's the Euro Fixed Fund. And then now we have the multi-asset strategy. As I said, it's a global themes fund. We invest in these global themes. It's an active, high return fund, if I may say so, based on these global themes that we invest in. And we have the Mambruk Sharia Fund. It's also a multi-asset strategy fund. It's a KES denominated. You can appreciate that they are not much of capital markets products for the Sharia space. And so with this fund, we are creating these products for this market space. And it's actually a very good active fund. And then finally, we have the money market. Current yields for the money market is annual effective yield is 17.4%. So this is the premier cash management tool. So basically for an investor who is looking to invest with our products, one, you can learn more about each of these products on our website, www.avocap.com. Two, you can download app. We have created a very intuitive, best in class or best in market. You can download it on Play Store or App Store for the iOS. It's called Avocap. So once you search ARVOCAP, Avocap, you get this app, self-onboarding platform. So it means you can self-onboard yourself. You can monitor, you can load funds into your account. And whether you're doing M-Pesa or bank, the moment you get the message from your bank that you have transferred 2 million from your bank to our initial stream account, if you go to your app, you already see the funds reflecting, so you can make the quick investment decisions. So any amount, whether it's M-Pesa, you can STK push from the app, you enter your PIN, and you uploaded your account and you can start investing. You can monitor performance, any performance. You can see how the funds are growing every day. You can download results. And that's the beauty about our app. It's a very good, I think the reviews you have gotten, it's quite good reviews. So yeah, I would invite anyone who is here to go to App Store or Play Store and download the AvoCap app to start the self-onboarding and investment processes. More than that, our offices are in reliable towers along Mogoshi roads. You can always call us or book a meeting for us to come and discuss about your investment goals, your wealth journey, what you're aiming to do, and how basically the AvoCap products can help fit into your wealth growth goals. And it's glad to be with you and just to share these pieces of information. And feel free to book us, to write us an email at invest@advocap.com, book free or book a wealth advisory meeting. We just speak about your wealth goals. What are you looking to achieve? Or even on email or even one-on-one. I will guide you that investment process.
Thank you, Wilson, for that information. Bill, you can also tell us about Kuza, your product, and how to find you.
Thanks very much, Namsia, and thank you to Mango Capital for organizing this session. I think it was quite good, quite positive. So thank you very much for that. So I think for us, we have our various social media pages. So again, on Facebook, in TikTok, X. Again, you can actually be able to at least find us on those particular pages. Kindly follow us if you can, tafadhali. And then we similarly have our app. One can actually be able to go to the App Store, the Play Store, and download Kuza.Africa. That's our app, Kuza.Africa. I think that those are basically the main ways in which we can actually be able to interact. And again, on our website, there's actually a cell phone number there that one can be able to find. I'll just say it very quickly. But again, it's on our website. So that's 0705 666 444, 0705 666 444. But it's on our website. You can call and you can ask for me, and I'll be definitely available to at least have a discussion. And then we can definitely take it from there. I think maybe the last thing I can say just from Kuza's perspective is that we are very positive about the country. We've had a very rough few weeks, if not a few months, especially because of some of the economic challenges we're experiencing. But then again, we really take heart from the fact that the fundamentals of our country are relatively okay. Of course, things could improve. Our economy is actually the 7th largest on the continent. We have a combined GDP. Our GDP is actually 83% of the combined GDP of Uganda and Tanzania. So our GDP is 83% of the combined GDP of Uganda and Tanzania. Ethiopia has more than twice our population, but they're only ahead of us by around $50 billion when it comes to our GDP. We are a regional financial hub. We are a regional political center. And of course, we have issues with our debt. But then again, we have all the right factors in place, from the IMF to the World Bank to the other multilateral lenders who are willing to work with us. So again, if you're thinking about your investment journey and how you can actually be able to navigate some of these dynamics, feel free to please reach out to us through our social media channels, or you can call us. Then you can just ask for me. I'll definitely make time, and we can keep engaging from there. So thanks very much from us. This was a very good session. Tumeshukuru sana. Thanks very much, Namse.
Karibu sana. And we will wind up there for today. If you want to reach out to Kuza and have a club, they've given the details. You can call them, email them, follow them on the social media pages. And thank you so much, Bill and Wilson, for gracing our Twitter spaces today and for the informative session that we've had. Thank you, Kuza, and thank you, Avoka. And good night, everyone. Thank you.